Back after a busy week in the markets, let's just get right to it. This week I'm going to go through strong week for stocks. Saw a big sentiment shift already, and I think that's important to just kind of think about because we ended last year. That was one of the big negatives going into this year. It's very surprising we were already able to dent the sentiment. Talk about what appears to be the thing that people are going to be worried about. I listened to a couple podcasts this week where this theme was represented again by macro strategists. And so instead of a recession, we've moved on to back to the debt and inflation and the dollar and everything. So we'll talk about that. China, it's time to focus on China. It's going to be very important in 2025, partly because of the tariffs, but partly because of what's going on there. The AI impacted jobs. I think it was a big week for that. I'm going to keep talking about it all year because of the agentic AI, which I think is critical for people to focus on. And signs of a crypto bubble. I got a lot of conversations on it this week, so I thought we'd talk about it. S&P, big rally, made new lows. That's the weekly chart. We were able to rally back. We didn't take out last week's lows, but it was a very, very strong week. And when you look at it this way, it was the best week for breadth. That is the percentage gain in the S&P breadth. Remember, that's what had been leading us lower since the peak was we were going down. I had been highlighting that breadth had been weak in December, which is what we had here. Well, we just had the biggest spike in breadth, and this was what started the beginning of this rally here, and then this one occurred after this bottom here in 23. So the last two times we had big breadth thrusts like this, it ended up carrying on. I kind of think that's going to happen again here, although I'm not expecting a major move up, but I do think that we came out of last week showing a lot of signs of strength. The Trump trades, everything just kind of boomed back up to the highs except for the IWM. So you've got Bitcoin in here, you've got the data center or power trade, you've got the local cyclicals versus defense, non-commodity cyclicals versus defense, you've got the onshoring trade, you've got the deregulation trade. They were all up strong. So after everyone had said that the Trump bump was over, we resumed with the trades, the market neutral trades that showed it. And here we are month to date. We finished after last week, despite all the negativity, but behind everything we had heard, people getting bearish. I'll show you some of the sentiment. The S&P is up 2% month to date. I'll remind you, in a year last year where the S&P was up over 25%, January was only up 1.5%. So we're off to a better start right now than we were last year, except for it's completely different what's leading. So I've talked about energy. Energy is the best performing sector. It's up 9% so far on the back of crude. Materials in general up because of commodities, financials, or I'm sorry, industrials. A little bit of a PMI trade here. We'll talk more about that. And then you've got financials, kind of a value bend. A different story than last year where you've got the tech names lagging behind Amazon, commercial, the communication services group, and the tech group. Here's the sentiment. So we were up here in December. This is the AAII. Came down sharply to the lowest level since 23. You've got the Investors Intelligence, which is newsletters. It usually takes a while to move this thing. You can see how it took a long time to get from here all the way up to here. Well, it just collapsed. I don't remember seeing anything like that without there's some big event going on, like in here when oil had collapsed and the stock market had gone down significantly. The market fell, but it didn't fall much at all to turn this so quickly. So people turned real negative very quickly, or at least let's say back to a more normalized level. This is the Goldman Sachs sentiment indicator. It dropped back to here from up here. So regardless of which measure you look like, it was a big drop off. The thing that really got things going this week were the bank earnings, which across the board were just big. I can't remember the last time that we saw that kind of strength coming out early in the earnings season from the bank stocks, which are critical for this year for two reasons. One is you've got the deregulation theme opening up M&A. So investment banking is going to be a big focus this year with Trump. But you also have the AI agents where financials should be driving productivity there. And I think you're going to see that, and I'll highlight that as well. And that's what showed up kind of in the earnings side is when you go through so far, and we're very early in, but the surprise, we're 42 out of 500 in, so we're not there. The sales surprise revenue was not huge, but the earnings surprise was big. And when you look at it down here so far, and again, this is only 10% of the way through. We'll see how it plays out. But you're off to a great start on the earnings, and that led to the rally, helped the rally we saw. The profit margin story. This is going to be what you want to watch. I would look at the FactSet earnings insight every single week during earnings season and just see how these trends are looking. You're going to see this is Q4 versus Q3 financials, big boost. This is a story about productivity where bearish people remain, again, is not focusing on the benefits that are going to come through AI. I think this acceleration is far faster than people realize. I've talked about it repeatedly. AI agents are here. They're working now. They're going to be integrated every single quarter this year and much faster than I think people realize. So just keep your eye on it. The other important data point was the inflation side. Supercore came in. It was the lowest reading since second quarter of last year. And the reason that this is important is not kind of where it is. It's just the fact that inflation is remaining tame. Oil is starting to move higher. Commodities are going to go up. So you're going to get the headline CPI for sure to go. But this is actually continuing to be on the side that suggests that maybe we're all, in this inflation is going to stay higher thing. It may stay higher, but I don't think if it stays at 2.5 to 3.5, it's a big deal. I think if core goes back up to 4 to 5, it's a big deal. And every time we get a print like that, it suggests that we're going to be stuck on the lower side. Now, this is the sticky. So I use and I've shown this chart before. The white line here is the 3-month annualized core sticky X shelter, which is sitting at 2.5. So it's been migrating lower. It led the way down before the actual CPI, which is the orange line here, did. So core CPI kind of went sideways here at 3.3, but the ones that I use more, which are the sticky side, this stuff has dropped below 3. So I would just keep your eye on it. The other one there is the 12-month. So if the 3-month annualizes down here and the 12-month, so the annualizes up here, the inflation data is going to have to switch soon, or people are going to have to get less worried on the bond market. And I think if the inflation stuff stays there, I'd actually lean a little bit more towards the side that there could be more fears later on in the year related to slowing growth rather than inflation. But we'll get to that when we get to the job side. 10-year rates. Technical pattern. I'm just showing this because since September, we've had rates moving higher. This has been the major thesis that people have jumped on. I'm telling you, after watching this reminds me of recession calls. Everyone takes this trend that's gone on. They talk about the Fed cut rates. We get 100 basis points up. That means we're going to have a death spiral of rates moving higher and the dollar. I don't buy into that. I just have not seen people call rate rises when they've already had a move and been right about it. And almost everyone is writing about the fact or talking on the macro side that rates are going to go higher. I understand there's a lot of debt. I understand this whole thing. But the reality is we were right around this level in April last year. So you want to watch for signs that we're going to head back down, even if it's to 4.25. If we spend the year between 420 and 480, it's not going to have much impact on the market. So you just want to look for technical signs that this is going down, because whenever rates go down right now, it's good for equities. You have a divergence here. This is the MACD sell signal. You can go look at the one that happened here up at extreme levels. We came off here. Even if we get this little fall, like I said, we come back down to say here and then we go back up. Equities are probably going to bounce. So just keep your eye on 10-year rates. We did have lower inflation data. So the technical signs are there. What has not gone yet is the dollar. Now we have a similar type thing in the dollar, but the dollar has also had a huge move since September. So it's been this combination of the dollar's moving higher and we've got rates moving higher. These are going to have an impact on the economy. These will have an impact on the global economy. My opinion is blah, blah, blah. Unless it's going to be an extreme move. This is pretty much everyone jumped on these trades going into Trump. So it wasn't just the Fed. It was the all clear from people's minds when the Fed did a lot to stimulate the economy. Then you were going to have the bump from Trump. Here's the reality of where the dollar is. Year over year dollar is up 6%. It's not at these levels anywhere, but the main point of this at this point, we're entering into the inauguration, and you'll hear me talk about this a lot. It's expected that the dollar is going to strengthen. If the dollar weakens for any point, which I'm going to go through when I get to the China piece, it may be a sell and news event when the inauguration happens. If the tariffs don't come in the way that people expect and they do them in a staggered approach, you'll probably get some lessening. At the same time, there's a lot of people, smart people, that are talking about the possibility of some kind of big deal with China because their economy's weak, and maybe this is just trying to negotiate a better deal. We'll see what happens, but when you have everyone expecting something and they're tilted one way where the sentiment is there, I think now's the time to start looking at what's happening in the dollar and see if we can get a counter trade. In terms of, again, the signal that for you guys to watch when I'm not doing these recaps, here's the junk spreads. They didn't, or this is the OAS for investment grade. You just have no movement in credit, and you had rates vol, which have stayed near the lower end. So this whole kind of fear factor that people have just didn't translate into there. If rates are going to have an impact on the economy, you would at least start to see spreads widen, but that didn't happen. Here's another way to look at it, and I just want to make sure everyone realizes, because I get asked this question a lot. The junk market is a absolute indicator of the equity market. So if the junk market remains stable, the weakest part of credit, the equity market, which has been weaker, this is year over year world index, which is up 6%. It went from a peak of over 20 all the way down here. All this while spreads have tightened. So this is spreads inverted. You can see the correlation between these. If there's really something going on, the credit spread should be widening as well. And that's just at this point not happening. So when we see credit spreads start to widen, that's when you can start to worry that what's going on in the equity market's going to turn into something bigger. All right, this was the stuff on China that I want to jump into and do some work. So we haven't talked about China in a while. They did their stimulus. I've talked about the fact that people fading it, I think, is a mistake. And here's what we got: M1 jump. We got the December numbers, just higher than expected. And so the quarterly increase in money supply, M1, which is an important indicator. Remember, money supply in China is double the size of both the US and Europe. So it's as big as Europe and the US combined in money supply. 6.8%, highest level since 2016 in terms of money supply. This is good for everything related to liquidity for sure, including Bitcoin. You finally got some reaction in the Hang Seng market. We've seen the stocks hold up very well in the local markets, but we saw the Hang Seng Corporate Enterprise Index have its biggest weekly move since October, during the 3 weeks when the stimulus came out. In terms of the money supply and just showing its importance, this is a chart with year-over-year M1 in China overlaid with the local market in China, local stocks. So you can see the bounce that happened in September. We've consolidated in kind of a nice little pattern here. You'd like to see this move higher, but you're seeing M1 go higher. If M1 continues to go higher, fully expect that that's what you're going to see there. Other markets that you don't think about. So the DAX is making new all-time highs, and everyone's talking about the fact that, this is shocking people when Germany's in so much trouble. Germany is basically, when China's in trouble, Germany's in trouble. So I just wanted to highlight that the Shanghai Composite, which is the orange line here, overlaid with DAX relative to the S&P. And this gets important as a lot of people are looking to play foreign markets over the U.S., which, again, I've said before, I don't have a problem with it. I just don't think it's a trade worth expecting too much money on. The only way you'll make much money is if the U.S. goes down, which I don't think will happen. But if the Mag 7 don't do as well as they did last year, which I think is going to be the case, you could easily have the European markets go. But the thing to look at is we're seeing the DAX outperform the S&P, which is an indicator that China is starting to see some positivity there. Commodities index, the Bloomberg Commodity Index, made its low right at when China started doing stimulus in September, and now we've made a new high for the last 6 months, and we've made a high going back to 22 on the year-over-year BCOM. So commodities have been consolidating despite the fact that China has been in such dire straits. So any kind of increase in China, and I don't expect a big explosion in things, but I do think they're committed to getting their housing market to stable and their stock market higher and retail sales up. And I think all of that should lead to a better environment. Not a great environment for commodities, but a better one. I think most of the impulse for energy and commodities is going to come from the build out of the data centers and the explosive demand needs for power from AI. But here, the white line here is iron ore prices. Iron ore prices are nearing the highest level. Again, they bumped up in September. They've consolidated in a nice pattern, going higher. The reason I included this, I'm trying to give you guys areas where I think there's some laggards. I think the metals and mining stock, which is the XME here relative to the S&P, I told you I think this was a capitulation in December, so I like kind of this XME over the S&P 1500 for catch up. If iron ore breaks out here above 800, I think you're going to get a play in the metals and mining names. Another reason to be positive on these types of things, another indication that China is having an impact. We got the Philly Fed numbers, and I do a 5 month smoothing of the outlook for the Philly Fed, which has now bumped up here. This is it overlaid over time with the PMI, which is the red, which has been below 50. I think we're definitely going to get above 50 sometime soon. And then you've got the green line here, which again is already above 50, and this is the new orders category. So new orders is above 50. The outlook for Philly Fed is up at levels which has historically been in the 60s for the PMI. I don't expect it to go that high, but you have positive signs showing there, which again indicate positive for China. The reason I want to bring this back into the U.S. equity market so you guys can understand the way that I look at markets, looking for what would be the headwind that has been on the equity markets recently, it's been the dollar. Well, here's the dollar return since China stimulus. So when China does stimulus, normally you'd see some strength in some of these because a lot of these are commodity-based currencies. Like I said, Germany is related to China. This is the majors. This is all the majors that are listed in Bloomberg against the dollar. So we've had a 100% weakening since September 17th, which is right around the time of the big stimulus, also around the time that the Fed cut 50 basis points. And you've seen, no matter what it is, you've seen a huge move. But in particular, New Zealand dollar, Australian dollar, Brazilian real, they've had huge moves to the downside. And that has led to a very steady trend. And you think about the fact that the Trump trades, which really started, so here's a lead in, that could be the Fed, then you've got the Trump trade, you get a little bit unwind, and then you've just gone straight up. Now, what I like to look for is I like to look for when we start to see a momentum shift in terms of rate of change. So this here is the 3-month rate of change, 63 days. It peaked here on December 26th. I highlighted the date. So even though from December 26th, the dollar has been going higher, it's been struggling a little bit more. And those are usually signs of exhaustion, and those are the types of things I look for. I also look for diffusion indexes to see if some of them have now started to outperform. So what you have here is since that December 26th, when the dollar started showing signs of exhaustion, you have about 6 currencies that have outperformed: the real, Norway, Canada, South Africa, Australia, New Zealand at the top. Well, these are all commodity-based currencies. These are the ones that you would kind of expect to rally if China's stimulus was starting to work. So there are 2 things about the dollar strength that have gone on. One has been our own economy, but the other, very importantly, is that China was in a deflationary spiral, which contributed to it. If we're getting any shift here, the place where you should see it is in the commodity currencies. This is an indicator I created a long time ago. It's an equal weight of 6 different commodity currencies, the ones I mentioned plus the Chilean peso. I equal weight them, and then I just look for a sell signal. I highlighted these areas, which were in the beginning of 2016. This was a major turn for commodities, a major turn for China-related trades. That was the U.S. Shanghai Accord. This is obviously coming out of COVID, the exact level. And again, this is when PMIs bounce. This is when China does well. Same thing happened here. This end of 22, which is when the Fed pivot started, but it also coincided with the beginning of a fake or a false China reopening trade, which led into them continuing lockdowns. But China had a big rally here into there. So we're close to getting a sell signal in terms of breaking through the 5-week moving average. In these other places, it did that. MACD, we got sell signals there. This is something I'm looking for that I think if we get a turn, I would expect it to come from the commodity-based currencies. This is just showing what happened to the Shanghai composite on those exact points. So you ended up, this is the fake reopening trade where it was the most popular trade at the beginning of 23. No one's really talking to China. In fact, they're fading it because it's come down. But again, you've had this rally here since the stimulus started. It's the currencies that haven't joined. So I think you want to watch the dollar. Just showing the extension of China M1 into the euro. This is year over year China M1 versus the euro. and it leads by a while. So I moved it back to make everything line up. So we should be expecting some kind of euro bounce here based on this time period. So I'm looking at this point for that to play out. One other piece of news item, very important in China this week, was their home prices month over month. Were only down 0.08% in the 70 cities. So you've seen, again, September was the low, and now we've gone higher. We had a similar move like this in 14, and then you got a big bounce. China is targeting the housing market, and the reason is when we have a Fed put in the US, it's on the stock market. China has to have their house prices at least be going up a little bit. They don't have to go up much, but they need them to go up because this is what creates stability in China from a sentiment basis. It gets people to spend more. They have about 80% of their ownership in terms of individuals in real estate, not in stocks. So the stock market going up is not the only place. They need to have real estate, and there's no way to refute that right now we're getting a positive trend in this that started at the stimulus time. So again, another positive. Also going into the end of the year, I think it's important just to realize that right now, we've got a record. This is from the IMF forecast for this year. It's a record low of countries expected to be in a recession. The reason I bring this up, this is mainly because you have to remember there's still a lot of rate cuts that are coming into here, so they were expecting positivity. Anything in China will be a positive thing for the world markets. And at this point, the world markets have been trending nicely, but more importantly, and this is the world index I showed you year over year versus credit spreads, it's gone sideways now since September when China stimulus went through. So world stock markets overall, that includes the US as well, have just hung in. On the tech side, I mentioned last week, this is probably the best podcast I listened to this past week. And the reason I say the best, if you haven't listened to BG2, they're very good, but more importantly, look what they talk about. Rates and inflation, Doge, CES event, AI compute. I mentioned last week, if you're only listening to macro forecasts where all they do is talk about the rates and inflation and Doge and a bunch of old statistics, and they don't mention anything about these, I'd rather have people that know about this and very little about this, because very seldom are people right on their forecast on rates or anything when it comes to the macro side. So I would just remember, you got to be on AI right now with people to talk about it. In terms of AI agents, you're going to hear me go through this a lot, but there's a report out from BCG on how much people are already spending. So 1/3 of companies plan to spend more than $25 million on AI in 2020. Widespread optimism for AI agents, autonomous agents. They did talk about job fears overstated, less than 10% of expected decrease in headcount. We'll talk about that as we go on, because even if you don't have a decrease in headcount, as I've mentioned, I'm more into the hiring side, which we're just not seeing data on. More stuff on just the size of it in terms of this. This was a Forbes article on agents. This was a news stack thing on them about to blow up. And then Goldman had a productivity thing out again, and the numbers are fairly staggering. This is why it's so important. Predicts AI could boost labor productivity by 0.3 to 3% annually over the next decade. I mean, these are huge numbers to even think about getting anywhere near that. The Industrial Revolution is what they're comparing to. It was 0.8% annually. So they're talking about this as an unprecedented shift. And like I said, profit margins, productivity for the economy. Basically, the only thing you need to think about with productivity is the ability to do more with less. Layoffs announcements. And again, I think this is going to become more of a story. And remember, Microsoft laying off employees. Forget where they're landing. They announced layoffs. Meta to cut 5% of jobs to lowest performers. These companies are the best performers and making the most money. So when I hear people talk about the fact this must mean the labor market's weak, no, these are companies that know AI is going to replace middle management. And you're seeing that in stories like this, which came out this week, which got a lot of press. I heard it on the All In podcast today, but it caught my attention because why do you stop hiring MBAs? MBAs are not getting hired, and part of the reason why is because of AI. It's a middle management thing that is really becoming a big issue. So in my opinion, the larger companies right now are focused on doing more with less, which means not hiring people and finding ways to integrate AI. A lot of the people that are not getting these jobs, they're going to have to go to startups. MBAs they went and got those MBAs thinking that they'd get paid more money. You're having a problem on the jobs market, which is just going to be there. And I just want to show this because Longview, which does some great tweets, and I'm constantly looking at their information. I thought this was interesting. I've highlighted this before, but I just want to make sure when you think about AI and you realize if you take in kind of where we are on this stuff, information, manufacturing, professional business services, I've shown the temp numbers. Aside from government, federal, state government, local government, and leisure for travel, which will be hard to replace, and private education and healthcare. That's why I think the jobs market is just going to remain soft this year. I don't expect a recession, but I also don't think it's going to be a situation that people are going to be excited about. All right, so let's finish off with Bitcoin. It broke above 100,000 this week, and the the X tweets are lit up with bubbles again because of this stuff. Fart coin jumps 15%. Yesterday, Trump coin was up big, and there were stories going around. It's already up more than the S&P 500 in its history, and blah blah blah. MicroStrategy, desperate Ponzi scheme. Ripple this week was up. So XRP's market cap this week up huge on hopes of deregulation, surpasses that of Wall Street giant Goldman Sachs, rising to a 7-year high. I, I just wanted to bring that up because those stories, which again, when people talk about them, they spend no time in understanding what goes on with coins. I have no desire to ever get involved in any meme coins. So the Trump coin and the fart coin, I'm not going to get involved. But these are not like equities. So to compare the move, to compare the market cap and act like you could actually make that kind of money or be involved in it in any meaningful way, or that the volume is big, it's just literally looking for things to call a bubble. And I think it's great for people who love Bitcoin. And so I love seeing all this negative press. I love keeping people out. This week, or 2.5 weeks ago, I went to try to buy some IBIT from my Merrill Lynch side, and I couldn't buy it. And I was in shock. I mean, I have enough money to be a credible investor, plus have a background in it, and I couldn't buy it. I had just done a bunch of work on MicroStrategy for a variety of people, just to show them why it should trade at a premium to their holdings. And so I just turned around because the premium was at the lower level. For those of you who follow the premium in MicroStrategy, I use MicroStrategy as a sentiment gauge, thinking that about 150, 175 percent premium to the holdings is about the low end, and then when you get up towards 275 to 300, that's the high end. But for anyone who wants to hear more and more about why I think there's a justification for the premium, for a variety of reasons, on the technology side, on the fact that Bitcoin options trade with call options trade with a premium, this is a levered way on it, and the fact that, like I said, I couldn't buy IBIT, which, believe it or not, is the case for almost every wealthy individual in this country who has their money at any of the major platforms. They still can't buy it unless they go to them and they go through some kind of approval process, because supposedly it's some illegitimate thing, and Vanguard still is telling people not to buy it and they can't buy it. So how can we have a bubble when they're restricting people from buying it, and we're finally getting an administration that's going to support it? So here's the Bitcoin price. For those of you, the dollar I mentioned, so here's what Bitcoin has done since November. Completely sideways. It consolidated the moves. The dollar just had a little consolidation and then continued to move higher. So when Trump takes over, if people are worried that that'll be a sell and news event in Bitcoin, we've already consolidated here. We've consolidated now for almost 2 months. And last week we got under 90,000 and finished up above 100. So if anything, it looks like there was a lot of energy to move it down here. I got a lot of people seeing the head and shoulders formation, saying who wants to buy this chart when it looks this crappy, and then it just went straight back up. No one talks about it when it goes back up, other than it's just doing what it does, but I think it was a major week for Bitcoin in terms of just continuing to move higher despite all of the bubble talk and everything that's going on. I mentioned this last year, until Bitcoin outperforms the Mag 7 like it did here, I'm not even considering any kind of a top in Bitcoin. I think we're definitely going to get up into this level. So you've got a significant move, and I don't think it's going to happen with the Mag 7 necessarily going down. So we're talking about a significant move before we get back up there, but I do think it'll happen sooner rather than later. So this is the chart. This is long Bitcoin, short Mag 7. Bitcoin moved up to be the 7th largest asset in the world. moving up the ladder quickly by the end of this year. Based on what I think will happen with it, I do think you have a chance to get up to the number two asset. So I'm looking for that for Bitcoin. I'm looking for a big enough move as Trump takes over. Just a lot of news going into the inauguration, talking about a first day Trump order for a stockpile of Bitcoin. That was in the New York Times. Now you've got Bloomberg designate cryptocurrency as a national priority. The Washington Post talking about repealing SAB 121 in terms of getting into the bank's holding digital assets to count them as liabilities on the bank's own balance sheet. And then again, this is just a summary of everything that went on. The reason I'm bringing this up is, again, I don't understand how people can be negative about this with all of these indications that the administration is going to make this a major thing. And if the prior administration had been somewhat supportive of it, then I wouldn't care. But they literally were strangling it to keep it from doing anything positive. There's a crypto ball this week. Now we have 10 states. This just keeps going over that have introduced legislation for a strategic Bitcoin reserve. For those of you who don't realize the importance of this, even if none of these make it through, the Republicans will vote for it. The Democrats will most likely be the ones who vote against it. This has become a major voting issue, and eventually people will have to turn. So I'm expecting on a lot of these votes that you're going to see people on the Democratic side be forced to jump into this. So just keep your eye on this. I don't think this can be an issue that the Democrats can just continue to say is a scam. You may have seen that Bitcoin fell, and there was talk that there was going to be 7 billion sold from this Silk Road. Well, Lummis was all over the tape in the last week, demanding answers from this. Basically, they're going to force, again, people on the other side to publicly say why they wanted to do things. She met Strategic Bitcoin Reserve. We're working hard to get it in comprehensive legislation across the finish line. She's all over this stuff. Wyoming legislation to allow use of permanent funds to buy Bitcoin. That was part of the states. And then finally, one last letter. I've mentioned Caitlin Long. She and I have spoken. If you haven't listened to her talk about Operation Choke Point, I bring this up again because this here is Lummis again, and this time it's going through to find out what they were doing to conceal materials related to Operation Choke Point 2.0. So you're going to see more and more, I think, news that comes out about how the prior administration was doing everything they can to prevent crypto from being a part of what's gone on. Now you have a flip the other side. So when you get a headwind that becomes a tailwind, I just think don't underestimate what's going to happen in Bitcoin. That's it for this week. I will see you guys next week.